Let's bring in Farai Mwakutuya. He's joining us from Zimbabwe's capital with more context on this story. So, Farai, let's try and square this circle for our viewers. Zimbabwe has gold deposits. Bullion prices are at record levels, up by over 25% so far this year. And since the ZiG is nominally backed by the country's gold reserves, why is its value against American dollar in decline?
Well, Rama, I had an opportunity to speak to the finance minister soon after the State of the Nation address. It's a question I put to him to say, look, people are questioning whether this currency is indeed backed by gold because of that devaluation. And his answer was the fact that gold reserves and other minerals back ZiG, but the ZiG exchange rate will not necessarily be pegged to the value of gold. It's quite vague, but the way I understood it is that he's essentially saying that the government has reserves. It's sitting on reserves of gold, minerals, and US dollars in its vaults, which it will use to intervene. It will pump into the market in order to support and to prop up the value of the ZiG from time to time as and when necessary. So even if the price of gold does go up or down, it does not necessarily mean that the price or the exchange rate of the ZiG will be pegged to those movements. It's essentially just saying they have a vault or reserves of US dollars and gold and other minerals, which they will use as and when required, when called upon, to support the ZiG. He said that they have adequate reserves. He said about 317 million US dollars worth of reserves to support the ZiG. But to the latter point, why we saw there's a decline, I think it was as a result of calls from the market, pressure from the market to say less the exchange rate could reflective of the market dynamics. And the market was at about 25, 26, and that's where we've seen the ZiG go now.
Indeed, and that brings me to my next question, because we've had this phrase from the president today and last week Friday from the central bank as well. The president was speaking of allowing greater flexibility on the ZiG. But what does that then translate to in practical terms? Because one way of reading it is that essentially authorities are sort of trying to control the price at which people could actually make trades that would then determine the value of the ZiG.
Well, Ram, I think there are two ways of looking at that and the logic and thinking behind that. One is on the trading front. If you look at retailers, and I think to illustrate that point, maybe paint a picture of what was prevailing on the ground a week ago. A retailer who was selling a soft drink, for instance, which was $1 US. The equivalent of that would have been about 14 ZiG. Now, that would have been all right for a retailer to sell at that price because they would take their 14 ZiG, go out to the banking market and get $1 US. But because there's a shortage of US dollars, the premium was about 25, 26. So what ended up happening is that retailers ended up selling that soft drink for 25, 26, 27 ZiG. Now, that makes them uncompetitive because as a consumer, I'll look at that price and say, look, this soft drink is meant to be the equivalent of $1. It's now almost double that price. And so the flexibility is to allow traders and retailers, in particular retailers, to charge a fairer price and to be more competitive. But also what the devaluation will do is it will encourage those who are holding deposits of US dollars to trade those dollars. They were not trading the US dollars previously because they felt the exchange rate was not fair, it was too low, so it's not reflective of the market. And so they were holding back. A lot of exporters who have US dollars were not bringing them to the interbank market, and that's why we saw that shortage. So hopefully the authorities hope that by devaluing, they will see more people with US dollars bringing them to the market and therefore satisfying some of the huge demand for US dollars on the market.
One last question for you. The president also spoke about speculative tendencies, his words, not mine, on the parallel markets. But the counter-argument I'm sure that a lot of traders, retailers will make is, well, if we're seeing that the currency is essentially weakening, it makes sense for us to try and accumulate or hold on to the US dollars that we'd have access to in an environment where access to US dollars is fairly limited. So from the authorities' perspective, what exactly are they classifying as betting against the ZiG?
Well, I think there are a couple of things there. I think, first of all, people who are forward pricing. So again, using the example of a retailer who expects that the exchange rate is, for instance, 25 ZiG to $1 today. And if they are speculating that in a week's time it may be 35 or 40, they will price their goods based on that exchange rate, that future exchange rate. And that is speculative, and that is what authorities feel is also driving up the exchange rate, where people have this anticipation that the exchange rate will will go up and that the currency will be devalued. So that's one way. And so they end up overcharging in terms of those prices. But also, as you quite rightly say, a lot of people will, as soon as they get a ZiG, essentially try and spend them as quickly as possible, dumping them in supermarkets and people who are forced to take ZiG, trying to get US dollars as quickly as possible and holding on to them in the hope that the price will go up. So I think it is all those people who are holding US dollars, not trading them, people who are overpricing, who are forward pricing, and some people who might actually be going to borrow funds, borrow ZiG in the hope of going to buy US dollars on the market, holding those US dollars, and then trading them later when the currency is devalued, paying off their loans very quickly, and then making a profit. So it's that sort of arbitrage. And I think that's why you've also seen as one of the cocktail of measures to try and address the currency crisis, the Monetary Policy Committee also increasing the lending rate, is to try and put a cap on that sort of speculative borrowing.
Indeed, by a fairly steep margin, 20% all the way to 35%. We'll keep tabs on this story. For Mokto joining us there live from Harare.